So imagine this. You place a long position expecting price to come up, and you set your stop losses below and you take profits above as you would. Price fucks around, moves up and down, hits your stop loss, and then goes up and hits your take profit. So even though you were right, you ended up losing money from being right. So you got stopped out just before a move actually played out. How do we avoid this happening? How do we fix the psychological issues when using a stop loss when we're trading? Let's have a look in this video at how I trade and how I have no fear when I trade. Let's get into it. So I trade without using a stop loss and it works. I make money doing it. This is earlier this month using my bot. So as you can see on the top left here, I added a long position, a buy. And guess what? I was wrong and the market moved against me. So I added a second buy. The market continued to move against me. I added a third buy. And guess what? Price snapped back and had that retracement I was expecting. So I didn't use a stop loss, but I entered small positions. Each position size gradually increasing. So with these three positions, with gradually larger lot sizes as we go, my average price would have been all the way down here. So we have that snapback we're expecting and we get out with profit. Once again, I entered a long. And guess what? I was wrong. Price moved against me. So you know what I did? I added a second long. And guess what? Price moved against me again. I don't give a fuck. I want to enter another long position. And we have a snapback and I get out profitable. Once again, I did not get stopped out once here, did not get stopped out here, did not get stopped out here, but closed off all three positions profitable. And these examples just keep going on and on. So buy, moved against me, added another buy, closed out both in profit. And over here, I timed the market perfectly. Like I entered a buy here and it just went up. So I closed it in profit. I timed it that time. So if I was using a stop loss, I would have been stopped out 1, 2, this one would have made me profit. So if I were using a 1 to 2 risk to reward, I risk 1% to make 2%. Guess what? These two trades here, I just lost 2%. The third trade worked out. The third trade gave me my 2. So I lost 2, 1, 2, and I made 2% on my last trade. So with these three trades here, this would have just been break even if I had used a stop loss and a 1 to 2. With dollar cost averaging, I just got out with a profit with all three of them. Very nice. Now we're going to convey into why I do not use stop losses and why I do not trade using them, because you're going to lose money trading using a stop loss. I said it. Let's get into it. Let's have a look at the difference in psychological blocks and just your general psychology when trading when using a stop loss versus dollar cost averaging. So dollar cost averaging versus using a stop loss, what's the main difference? For me, I see that if you're using a stop loss, you're trying to time the market perfectly. By timing the market, you're probably using a lot more leverage than you probably should be trying to get those quick moves. However, this is a completely random market. It moves up and down randomly. You do not know what's going to happen. A bank may put a lot of money in the Swiss franc because some oil line's blown up somewhere. Australia could have bad unemployment rates come out and then the price is just going to tank. So good luck trying to time that. Dollar cost averaging, what we're doing is we're investing a small amount when a price move is expected to happen. Now, if the price keeps moving against us, there's no problem. We're going to average in and keep our average price close to the current price at the moment. For example, we have a strong move down. Price has pushed down very hard. Price at the moment is oversold. What does that mean? At some point in the near future, we're going to have some sort of pullback. We're going to have market structure. It's going to move in its legs. So we have our strong move down and we're expecting a pullback to happen. What are we going to do? We're not going to worry about timing our position. So we're just going to average in and keep averaging in until we have that snapback. If we were using a stop loss and this was our first position, expecting it to go long, guess what? We've been stopped out. Put another buy in with a stop loss, guess what? We've been stopped out again. By dollar cost averaging, all three of these positions are fine because when we do have that snapback, we can get out all in profit. So dollar cost averaging will remove emotion from trying to time the market, because if price moves against you, so what? You can average in. In fact, the more price moves against you when you're dollar cost averaging, the bigger your position size gets. So when we do have that snapback, you get out with more profit. So what you're doing with dollar cost averaging is you're focusing on the long-term growth. You're not worried about these quick moves, which are going to blow your account eventually. You guys probably often see fear or greed. These are the two emotions which will either kill or make a trader. You got to be nonchalant when you're trading. It's crucial. This is how you remain profitable. You got to control your emotions and avoid impulsive decisions. Being able to stick to your well-defined strategy will make you profitable long term. No matter what the market's doing, you can stay profitable if you've got good settings in your strategy. So it's actually quite easy to stick to your plan if you know that your plan and your rules are going to work and make you money long term, even through weird market movements like COVID or wars happening around the world. So I've run literally thousands and thousands and thousands of different backtest variations using my bot, and I found actually quite a lot of them were just profitable. Like hundreds of them were just profitable. But the strategy I like it because it has low drawdown and it makes me decent profits every year. So if I'm making these returns monthly and I've got a nice clean equity growth chart, other than COVID obviously, if I have a nice clean equity chart growth upwards, why would I deviate from my strategy if I know that it works? It's working through every market condition. Volatile markets, it did lose money, but it didn't blow the account. And guess what? It made it all back plus some. So why would I deviate from my profitable strategy if I know that it's a profitable strategy? So what you need to do is find a profitable strategy and stick to it. You're not system hopping, you're staying to the strategy that's making you money. So there's a few mental blocks when trading which most people struggle from. In fact, everyone will. It's human nature to feel pretty much all these points. If you stick to your plan, you don't have to worry about any of these. Literally, none of these bother you. And I must say, it does help using a trading bot because you're not going to get FOMO, you're not going to get greed. It's going to close out all your positions and close out all your take profits, do your drawdown control. It's going to do everything pretty much for you. And you're not going to manually trade, which is going to cause you to have these mental blocks. Why do most people fail in trading? It's because as human beings, we all want the perfect entry. We try and pick the top, bottom, or a pullback point that we think is going to work. We're taught this. We're taught by everyone online to use a stop loss, use risk to reward, and this is what we should aim for. We're told to put our stops under our entries, and we're told to cut our losers and let our winners run. But what's the problems with trying to do this? We constantly get stopped out. The market is random, remember? It's going to move, stop you out, go back up to your take profit, and you can do nothing about it because you're over leveraged. It's impossible to predict movements. The market is completely random. It's a coin flip, heads or tails. We don't let our winners run using a stop loss. We're watching it, we're scared, we're using too much leverage. We get losing streaks and give up. We get losing streaks and we system hop. If you system hop, you reset. We are not programmed to trade as human beings using a stop loss. It just hurts your psychology way too much. I'd rather go into drawdown and use proper risk management and average into a position, making me only temporarily wrong. So this position here, I added because I saw the supply. I added a sell here. Price moved against me. I added another sell. Added another sell up the top, bringing my average price to about here. We do have that snapback and I get out with profit. I'm temporarily wrong, but I'm not getting stopped out all the way up. So what you should be doing is dollar cost averaging, and here's why it works. First of all, we do not need the perfect entry. If we're wrong, it's fine. We'll just add another position. It's all good. We do not need to pick the top or bottom because if it moves against us, we average in. We do not need to put our stops above or below highs so we can keep getting stopped out as the market moves against us. Lastly, we let our losers reverse and become winners. So this is our first position here and break even. It was wrong that whole time. However, I got out with a break even. Profit, profit. Let's just have a quick look at the difference in backtesting results. Firstly, we'll have a look at a stop loss example, and then next we'll look at a drawdown control example. So, as you can see, these are the settings I'm running right here. So we're risking 1% and we're closing off 100% of the position if it goes into 1% of drawdown. So if our position moves against us and we go in 1% drawdown, we're going to close off 100% of that trade. So it's pretty much a 1% stop loss. We're risking 1% to make 1%. As you can see by the chart, we have a few winners, loser, winner, 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 loss, loss, losing streak, resetting you back, nice winning streak, stop loss, stop loss, stop loss, stop loss. So it's very jagged and it's very up and down, which pretty much brings you back to your break even at the end of the day. So the rules I'm running for this dollar cost averaging approach is risking 0.25% of the account and closing off 1/3 of the position at 1% of drawdown. So instead of closing off 100% and taking these losses, we're just closing off 1/3. So by closing off 1/3, we're essentially averaging out of positions as we're averaging in, which helps bring our average price up with us. And have a look at how much smoother this growth chart is. You can also see over here we went to a bit of drawdown, but that's no issue because at the end, even though we went to that drawdown, we still closed off very slightly less than what we were. We stagnated for a bit, but then just kept on growing as time went on. And this is what you'll see with dollar cost averaging. Most of the time, your growth charts are very smooth. So just from those backtest results, you can see the stop loss method is up and down all the time. We're waiting for the market to move in a direction we want it to move. We're trying to time it. That's going to make our growth on our account look very much up and down and pretty much break even. If we use the RSI moving average grid approach, this takes advantage of the flow of the market so we can constantly extract money from it. By dollar cost averaging, it is just so much easier on your psychology when you're trading. Because if price moves against your position, there's no problem. You've only entered a small amount. You're going to average in and you're going to bring the average price down with you. So when we do have that snapback, guess what? You got a great price for it. By using a robust strategy that you know yearly averagely gives you nice profits, we can trade with ease. There's no psychological blocks because we know if we just stick to our plan that we've created, we're probably going to be fine. Now, a lot of random events happen in the world that you just can't control. So this is COVID, March 2020. Russia, Ukraine, March 2022. You can't control these. These things happen and you're going to take losses. So if you've tested for at least 8 years, you know, over those 8 years, all these different market conditions, you're still profitable, you've got low drawdown, you can be a happy trader and not trade with fear or greed. So mainly what you need to get away from this video is stick to your plan. If your plan is profitable, why the fuck would you move away from it? Secondly, backtest. You do years and years of backtesting. You need to make sure through every market condition that you're profitable. Next, chart time is important. The more time you spend looking at the chart, the more you'll begin to recognize patterns. So dollar cost averaging, for me at least, is easier on my mind compared to trying to use a stop loss and trying to time a random market. This is because I have a set of rules, and if I follow them, I should very rarely get into situations that make me uncomfortable or losing money. Now, there are a lot of rules you have to follow when dollar cost averaging. It sounds easy, but you need to do a lot of different things to become profitable when doing it. So I'm not going to get fully into my dollar cost averaging strategy in this video. This is more based on the psychology and how stop losses actually hurt you as a trader. So obviously in the future, I'll be bringing out more videos. I also have old videos which you can check out. So like and subscribe. So if you have any questions about dollar cost averaging or how my bot works, I'll leave a link in the description for my Discord so you can message me. And then I'll also leave a link for a demo for my bot so you can try it in the backtester and see for yourself how well it works. With that being said, cheerio.